So this is week 36 of my TFSA portfolio, and today we're going to be talking about 3 stocks that I bought this past week, and 1 stock that I plan to buy in fairly heavily, at least for $200 a week depositing. I'll probably buy about $100 next week, and I'll explain later on in this video why I'm buying a lot of this stock. But before going any further, if you guys are new here, my name is Daniel, and here on this channel we talk about stock market investing. And in this series here, I'm documenting my portfolio, this TFSA portfolio that I started with $2,000, and I'm trying to bring it up to $50,000 by 3 years. And yes, I'm depositing $200 every single week. So I'll probably deposit around about $30,000 or $31,000 in the entire 3-year span, and hopefully the remaining amount will be from gains in this portfolio. So if you want to keep up to date with my journey, then be sure to subscribe down below. Also, if you want to start investing today and you haven't done so yet, you can get a free $50 for signing up for Wealthsimple Trade today, and that's a brokerage that I'm using for this investing journey. Also, if you're not really sure if you want to invest yet, however, your bank account doesn't pay you very good interest, then I would highly suggest checking out EQ Bank, which pays one of the best interest rates on their Canadian savings accounts. Now, with all that said, let's jump right into my computer and check out my portfolio. So we're here on the portfolio metrics page, and you can see the total market value of my portfolio is $9,829 and change. This portfolio is up 8.14% since I started this portfolio. If we compare it to the TSX, just if I deposited everything at the beginning on March 16th, I would have been up 13.6%. However, I didn't deposit everything on the 16th, and I'm doing $200 every single week. So that's how I'm actually tracking my change versus the index, where every single buy or sell that I do, I'm going to be putting that money into the index, or tracking if I were to put that money into the index versus buying the stock that I chose to buy. So if I would have bought the index instead of all the different stocks that I bought on every different day that I bought stocks, I'm actually down compared to the index by 1.13%. And if you've never come across my channel, you know that every single week I reveal to you whether I'm down or up against the index. So there's definitely no BS here because I'm showing my losses. However, these are all on paper. But my plan is to hold on to these companies for at least 3 years or for the duration of this challenge, and we'll see where we end up in 3 years from now. If we look at dollar amounts, how much my portfolio has changed, I'm up by $740. So not too shabby for a roughly $10,000 portfolio. Here's the breakdown of the different holdings in my portfolio, and you can see no position makes up more than 10%. TD being the largest one at 9.3%. So it's a fairly well-diversified portfolio, especially if you consider the sector weighting. I've got stocks from travel, healthcare, commodities, technology, telecom, finance, and all over the place. So this allows me to weather storms, especially if there's like a huge hit in like technology or finance. I've got other sectors that I'm in as well. So this should lessen the blow if one sector gets hit very hard. On top of that, I spread out the risk for this portfolio, making sure that I've got some staple stocks that are lower risk stocks, about 38% of this portfolio. Then about 20% of this portfolio is in higher risk stocks that some of them might like 2 or 3x in 3 years, and some of them may even drop by 60 or 70%. So that's why I don't have too much in the high risk stocks. I've got 42% in medium. And this is where I expect most of the growth in this portfolio to come from, where I think that they've got decent businesses and should do well if they execute well over the next couple of years. I've also broken my portfolio down into dividend versus no dividends, so about half the stocks in my portfolio do pay a dividend, which is nice. Now turning over to the transactions page, you can see that I also track the number of TSX units or TSX index units I could have bought instead of buying the stock that I chose to buy. So this is how I'm tracking my portfolio versus the index. But the stocks that I bought this past week are over here, which I've highlighted. I bought D2L twice, around the $17 mark. I think it's fair for the stock, especially they IPO'd at $17 per share. And it seems like the company's holding this price of $17, but as I explained in my previous video, as well as my analysis on D2L, I believe the stock is undervalued compared to all their competitors. They're about 50% undervalued if we're to compare them apples to apples to their closest competitor, which I believe is Instructure Holdings. You can check out those videos, which I'll link in the description down below. I bought 2 shares of Air Canada at $24.80, and unfortunately the stock continued to fall this week. It's trading at around $23 right now. And I did mention in a previous video on Air Canada, I think it was 2 weeks ago, I did believe that Air Canada stock got a recent pop just because of some reopening news. They also released their earnings, which had a lot of positive news for the company going forwards, especially with reopenings. That news is sort of short-term and temporary, and investors have now forgot about that and are selling off the stock. So I did think that Air Canada would come back down. And this week, I'll pick up a few more shares of Air Canada if it stays in the 22-23 range. The last stock that I bought was RioCan, and I bought 2 shares for $22.69. And for the prices that you're paying for the stock right now compared to where it was pre-pandemic, I think that this company has a lot of value to offer. They're still collecting about 95+% of their rent, if not 98%. So it's not like their business has been hit too hard by COVID, because the tenants that they have, they're ones that have very strong businesses and they're able to continue to pay the rent and operate as a business throughout this whole pandemic. Now jumping over to the entire portfolio, I've sorted this differently this week, where I've sorted it by the 1 week performance. So the top performers for this past week were DCM as well as Kinaxis. Now DCM is a stock that seems to have been floundering between the $1 mark and $1.20. So if you're looking to enter into a position for DCM, this is not financial advice by the way, right now just looking at the pattern, you could probably swing trade this at $1 and sell it at $1.20 and see where it goes from there. If I were doing this as a swing trade portfolio, I would probably do that. Kinaxis though, this stock has been pretty up and down. With all the supply chain woes right now, I think that's why it's picking up even more. So I think we've hit previous all-time highs for Kinaxis right now at around 230 or so. This stock, I probably won't continue to add more unless it falls back down, or if they show some really good growth in their business that's able to sustain even after this whole supply chain shortage. The stocks that did the worst this past week were Air Canada, which I talked about earlier, and the Bitcoin ETF. I plan to continue holding the Bitcoin ETF until the final push up for Bitcoin this year or next year. If you're interested, you can pause the video here just to check out my positions, but if not, let's move on to the stock that I'm planning to buy pretty heavily next week. So the stock that I'm going to be buying this next week is WELL Health Technologies. And looking at WELL Health stock chart, you can see that it was hovering around the $7 mark and trading above and below that. However, this past week, it decided to tank below the $7.50 mark, and today it's sitting around $6.25 or so. And if you've been following my journey just on this channel, you'll know that I'm very excited about WELL Health Technologies going forwards. The reason being is I really trust that management in this company knows what they're doing in the healthcare space. WELL Health is one of the first and largest companies out there that provide healthcare directly to Canadians. They also have operations south of the border in the US, and in fact, their US revenues make up more than their Canadian revenues. So they're expanding very quickly into the US right now. And WELL Health knows that patient care can't just be done through telehealth, which is what a lot of the high-growth health tech stocks this past year were in the business doing, telehealth. And WELL Health was grouped in with all these telehealth companies, but their main business is not telehealth. They do have a telehealth section in their business, but they also do in-person patient care through clinics. They do other things like health benefits. They also do some mental health stuff and other secondary healthcare things like physiotherapy or massage therapy. So they're trying to capture the entire patient experience within their own little ecosystem. So let's say you go see your doctor and the doctor's like, oh, you've got arthritis and you need to go see like a physiotherapist to help you just cope with that pain. So they would refer that patient to a physiotherapist within the whole WELL Health organization. And this is the strategy that WELL Health is using to be able to dominate the healthcare market. On top of that, they're also using technology to be able to enhance the patient experience. And technology also plays another huge role in the fact that they're amalgamating all these different sort of healthcare corporations under one brand. It's the fact that they can track the patient journey. And the patient journey is one of the most difficult things to track right now in healthcare, because you would go to a doctor and maybe you would see a physiotherapist, and then you would go see like a dentist, for example, and all three of those healthcare providers, they don't have a single record for you. So your records are all fragmented. However, if you have your records all under one company like Well Health Technologies, then they can better service you because the doctor would know what sort of other treatments you've been given at other healthcare providers and understand your medical history when giving you a diagnosis. So in the end, the patients that are part of Well Health's little ecosystem benefit, as well as Well Health itself benefits, being able to deliver more efficient as well as more effective healthcare to their patients. And most recently, I think the one thing that really stuck out to me about Well Health Technologies, or I guess there's two things. Their earnings were amazing this past quarter. They grew their business by triple digits in percentage points year over year. And the reason is because they're acquiring companies left, right, and center. One of their major latest acquisitions was CRH, and this is a huge cash generating machine, at least for the size of Well Health. They were generating tens of millions of dollars of free cash flow. I think it was $40 million if I'm not mistaken. And right now, Well Health is starting to reap those benefits because Well Health has turned from a cash bleeding company to a free cash flow or positive free cash flow company. Basically, if you are a business owner, that's really what you care about. You don't really care about like the equipment that you bought 3 years ago and is depreciating right now, taking away from your profits in this current year. This current year, what you're really looking at is how much money went out of the bank and how much money is coming in. Sure, equipment does depreciate and eventually you're going to need to replace it, but how depreciation works is a lot of this equipment is depreciated over like 5 years. But the equipment that Well Health buys, especially medical equipment, lasts for probably 10 to 20 years. So after it's been fully depreciated after 5 years, that item has been written off completely as an expense, but it can still be used for another 5 or even 10 or 15 years. So this is why I look more at free cash flow for Well Health Technologies, because the equipment that they buy will last generally longer than 5 years. Now, enough about the earnings report. The other part that I'm really excited about is the fact that they raised a convertible debenture from a pension fund. Now, the key point here is that they raised this debenture from a pension fund. A pension fund is very difficult to actually get money from. The goal of these funds is not high-risk growth stocks. Pension funds, they want to make sure that they have stable holdings in the companies that they buy into or the bonds that they buy. They need to make sure that those bonds will have a high chance of being repaid. Because at the end of the day, this pension fund is responsible for people's retirements, like 30 or 40 years down the road. So the fact that this pension fund was willing to invest into Well Health Technologies, they have full faith that this loan will eventually be repaid, and they could even possibly convert that into stock. And they're willing to go through with that at a stock price or a conversion price of $9.23. So that's actually trading about 30% higher than what the stock trades at today, which is around $6.25 or $6.27. Another detail you must know about this convertible debenture is that this debenture pays a 5.5% interest. And if this debenture actually converted into a stock price of $9.23 5 years down the road, if we were to back calculate taking out all that interest earned over the 5 years of this debenture, the current value of the stock bought at $9.23 in the future in today's price is actually around $7. So this is a lot higher than $6.25. So right now, buying the stock at $6.25 or so, you're getting the stock at a steal compared to what the pension fund is being offered as a future option to buy the stock. Now, granted, if Well Health never gets to $9.23 by the time we hit 2026 when this debenture is due, then the pension company is just going to take the money back and not convert the loan into stock. At that point, Well Health has got to have the money to be able to pay back this debenture. So those are two of the reasons why I'm buying into Well Health this week, because I do believe the shares are trading at a discount. The entire healthcare IT sector is on a discount right now. The theory right now is that people are selling off on these healthcare information technology companies because they're doing some tax loss harvesting, where other companies in their portfolio had tremendous gains. So if they sell off these lower conviction plays that are not going to have superb gains in the next couple of months or next year, they can take those losses and just minimize the amount of gains that they got from other positions. So that could be another major factor that's affecting the entire healthcare IT sector. And we know that in 2020, the healthcare IT sector was super hot. However, in 2021, it was pretty much flat or down. So my opinion is that people who are short-term investors are selling off on these healthcare IT stocks, and the long-term investors are still holding. But we're bleeding here just because there's no buyers out there. People are looking for quick and easy money like we saw in the past couple of years, and that's not going to happen likely with these healthcare information technology stocks. So in the meantime, I guess I'll just pick up more shares on the cheap and keep holding because my thesis on Well Health Technologies has not changed. Anyways, this video is a bit longer just because I wanted to go over Well Health Technologies and I haven't spoken about this company recently, so hopefully you guys got something from this video. And if you guys did, remember to leave a like down below because that really helps out my channel. I'll throw up a couple of videos on the screen right here. One of those is an interview with the CEO of Well Health Technologies if you're interested in learning more about the company. If you're there, I'll see you there. If not, keep up the grind and have a great day.